Hello friends, this is Rajat Dhar, Managing Partner of Finogent Advisory, and welcome to our first session after the budget 2021. And just 2 days back, we have also seen that first monetary policy review had come, which is around a bi-monthly thing, and it has come after the budget. And we have seen the budget has been fantabulous, and it has actually given the kick to the market, with the market Sensex even shooting northwards after around 50,000 and 51,000 Sensex level. So what does the monetary policy review has come up with the recommendations? So in this, there are the five important developments and five important news that I want to share that RBI monetary policy committee has brought forward and how it will impact you. The first and foremost, what they have done is they have kept the repo and reverse repo rate same, that is at around 4% and 3.35% respectively. So repo and reverse repo rates are the rates at which banks are taking lending and borrowing their money. That's the interbank lending say. So now the matter of fact is, keeping this same, what does it imply? It implies that everybody was expecting that since the inflation is hedging higher, that is, it is the higher end of the spectrum of around 5%, everybody was expecting that there will be an increase in the rate of interest. Had that been the case, then obviously the loan rates would have gone up, or even the corporate lending would have been hit hard by this. But since RBI had said that they have an accommodative stance, they did not change the repo rate, and it turned out to be a boon for the whole economy. This is because the markets are at such a juncture where the economy has started to bounce back, and जो contraction economy में हो रही है वो contraction भी कम होते जा रही है. We are coming at a zero par level. The second important development that has happened, that RBI under the digital initiative has announced RBI Direct. Now a retail investor can directly invest in gilt. So now what does the gilt means? Gilt means government treasury bonds or the government securities. Currently, if you would see that these were only institutions that were allowed to go for the gilt bonds, and that is the reason why mutual funds had an separate asset allocation within debt funds, which was called as the gilt funds. So gilt funds kya hota hai ki these are the funds which are 100% guaranteed by the government of India. These are the sovereign bonds which are guaranteed by the government of India, and you lend it. Now, these bonds or these funds are normally a very long tenure. These are around 7 years, 8 years, 10 years, or even 6 years for that matter, and due to which they are very much volatile. So in mutual funds, in these gilt fund categories, they have a total kitty of different gilt funds of different durations, different gilt bonds that they keep, and then investors get into it. So in the changing interest rate scenario, these gilt funds are quite volatile, but investors always wanted to have a direct access to the gilt funds, which now the government has is coming up with a detailed product note on it, how it will go. So I would say that it's a new product line that is open for the client. They have to open an RBI direct account with the RBI to fund this. What does it mean for the government? For the government, it means that they will be able to mop up more capital from the market, which will directly go into the government bonds and thus increase the capital raising capacity of the government. And obviously these are 100% sovereign, they are 100% guaranteed by the government of India. So this is how it is. Secondly, the third point is banks to provide funds to NBFCs under LTRO. So this news, LTRO means TLTRO means targeted long-term lending obligations, long-term repo operations, if I would say. We know that there are two sectors, one is automobile sector and one is infrastructure segment. So these two sectors are very heavily funded and supported by NBFCs. And if we see the coronavirus pandemic, or after the DHFL fiasco or ILFS fiasco, this segment had taken a very hit, and COVID pandemic was turning like a death knell to it because the lending has totally stopped. Now RBI in this monetary policy has made an announcement that under TLTRO, targeted long-term repo operations, they would be releasing the money from the banks to the NBFCs. So what does that mean? A flow of money from banks to NBFCs will go, and from NBFCs it will go into the most probably automotive sector and the infrastructure sector, because those are one of the largest contenders who are actually availing the funds from the NBFCs. So as far as this automobile and infrastructure space is concerned, and that is the reason why we had also seen over the last 2-3 days the automotive segment actually jumping up to the news. Then there was a restoration of CRR starting from March 2021. Now, every bank has to maintain a certain cash reserve ratio, and that cash reserve ratio during the COVID time was marginally reduced. And because liquidity was a concern and banks had certain money already as a CRR, so RBI had actually, you can say, loosened the cash CRR requirements, and they had provide them a leniency. Okay, you can have a certain margin for it, so you can continue. However, now they have said that now the time has come from the March 2021 in two phases, March 2021 and by May, that CRR ratio has again to be brought on to the normal level of around 4%, which currently is around 3%, and then they will reach to 3.5 and then 4%. So what does this mean for the banking sector? This means that much of the money they will again have to side pocket and keep it for maintaining the CRR ratio, which we might see a certain stress on the banks. But since banks are already too much funded with the cash and they already have much of the cash available with them right now, so shouldn't be much of a hassle as far as the bigger banks are concerned. Then the last thing that they made an announcement about the monetary policy review was a new digital currency. So cryptocurrency had been a recent fad with all new investors, old and new alike, are jumping into the bandwagon. However, the government is coming with a bill which will formally ban and make it a criminal offense to invest in private cryptocurrencies, and therefore they are coming up with their own digital currency. However, the product note for the same, the bill and all the nuances for the same are still awaited, so we can expect that to happen quite soon. So wrapping up all the five things here, if we see that, what does this mean? This means RBI keeping an accommodative stand, so there is no change in the repo and reverse repo rate. At least for next 3 months or to 6 months, we can expect no change in the interest rate. However, after 6 months, based on the inflation, if they go on increasing the rate of interest, then obviously the loans will be costlier and might also be a deterrent for the corporate sector. But otherwise, if you see from the retail person's perspective, it is very much recommended that you keep invested in the short term and ultra short term category of the bonds, because so that the volatility due to interest rate swings are prevented and your portfolio remains safe. Thank you so much for listening out to me. Have a nice day. See you soon. Thank you.